Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over a recession. And I know a lot of people are talking about recessions. Should I wait? Should I put money on the side? What should I do? Should I worry about it? Should I just ride through it? Are we going to have one? Are we not going to have one? It seems like a lot of people are worrying about recession. And just recently, I know I've seen a lot of people on Twitter talking about a recession's coming, inverted yield curve, all this other stuff. And I'm pretty simple, guys. I just look at a few things. I grabbed some articles here to talk about some other people's opinions on if a recession's coming or not. They're not my opinions. They're just other people that I grabbed from articles to give you their opinion. I don't think that we're going to have back-to-back recessions. I don't even know that it's even been in history like that. But everyone's claiming that oil is going to throw this into a recession or that the yield curve's inverted. And all I do is I look at history and say, look, we just had a recession in 2020 when they stopped everything. And we've got some other data here that I pulled up where people think that we're not going to go into recession. But if oil prices go to where I think they're going to go, potentially we could have a recession in 2023 or something like that. But let's take a look at what we've got. Let's look at some other people's opinions, and I'll give mine interjected in between. And here we go. It says, investing like a recession is coming makes no sense, says a strategist. And this was published February 22nd. It says, time for a touch of optimism. Recession concerns may be on the rise. See the Google search trends below. Thanks to soaring inflation, rising gas prices, and an unpredictable conflict between Russia and Ukraine. But that doesn't mean building out an all-defensive stock portfolio is the correct move, warns veteran JP Morgan market strategist. We think it is wrong to position for a recession given still extremely favorable financing conditions, very strong labor markets, under-leveraged consumer, strong corporate cash flows, and banks' strong balance sheets. The sector leadership remains risk on, and it is not consistent with a continued slowdown. And this is the Google searches for a recession, and it's peaking up quite a bit. It says, in turn, investors have rotated into perceived safe havens. Gold prices have gained in 12 of the past 15 sessions as the yellow metal knocks on the door of $2,000 an ounce. Shares of dividend-paying, consistent growing soda giant Coca-Cola are trading at record high. Upcoming recession scare best played via long bonds, short commodities, said the latest Bank of America fund manager survey. Other big names on the street agree that recession fears are perhaps too elevated right now. I think for the United States, don't underestimate the resilience of the U.S. economy. I think the biggest risk to the U.S. economy is a policy mistake from the Federal Reserve. That is the biggest risk. And so they're saying that they don't see this recession fears because what I think, I'm going to interject some of my opinion in here, is the run in commodities hasn't really ended yet. And we're still in that phase, the end of the expansion phase, the end of the inflationary boom of the business cycle and real estate cycle. And we just haven't been in that phase long enough. The economy can take far more than what we're giving it credit to if we get strong oil prices and energy prices and commodity prices. It's just, I don't think it's there yet either. Coming back up, it says, is a recession coming? Logistics company CEO says no. I've seen a few recessions over my career and they aren't fun, Jacob said on Yahoo Finance. I don't know that we are close to recession. Right now, the consumer is very, very strong and the industrial economy is in its early beginnings of growth. We do have to watch the effect of the European war and how that affects the world economy. We do have to look at how oil prices affect the world. And we do have to see how the Fed lands the plane in terms of raising interest rates in a careful way. But we are not close to a recession. Absent some big geopolitical jolt, there's just too much strength in the economy right now. And I think what he's talking about is what I'll talk about here with housing starts and permits. Too much strength. It says this is from a different article, so don't conflate the two. But here's from a different article. It says consumer prices rose 5.7% in 76, 6.5% in 77, 7.6% in 78, 11.3% in 79, 13.5% in 1980. Talk about being right on the money. And this was just the consumer prices had risen that amount for that length of time during that time frame. In 1979, right before the 80, we were peaking in housing starts, and the housing starts is what's driving all of this inflation, in my opinion. Housing starts and automobile loans. It's loaning into the system that's increasing the money supply. So pinpointing the moment, there's another article that I wanted to share. It says one of the best leading indicators of a cyclical downturn is the unemployment rate, which reached a cyclical bottom in May 1979, 5.6%, several months before the 1980 recession, and didn't peak until November 1982, 10.8%. The unemployment rate declined until the next upturn in layoffs began to accelerate in 1990. Currently, the unemployment rate has been declining from the lockdown peak of early 2020 and has reached levels that historically have signaled the beginning of the end of a cyclical boom. Lockdowns have undoubtedly distorted the unemployment rate, but the historical pattern reveals that when the unemployment rate nears 3% and then turns up, a recession will soon begin. That was some of the information for the unemployment rate. The yield curve is one of the most widely followed financial indicators that portend a recession, usually within a year. The yield curve reveals the relationship between short-term and long-term interest rates. Typically, the yield curve is upward sloping, like today, when short-term rates are below long-term rates, reflecting a substantial amount of liquidity in the financial markets. When the Fed becomes concerned that the economy is overheating, it tends to raise the Fed funds rate to cool down price inflation, which occurred prior to the bursting of both the 2000 dot-com bubble and the 2007 housing bubble. The yield curve was virtually inverted at the end of 2019, suggesting that a recession would begin sometime in 2020. However, the lockdowns in the response to COVID-19 caused an economic downturn in early 2020, not a typical cyclical recession. I've got some other writings up here. My fearless forecast, therefore, is inflation accelerates in 2022. Then the public outcry over skyrocketing prices and the media reporting highlighting how prices are decimating the average family's purchasing power may cause the Biden administration to impose wage price controls, as President Nixon did in 1971 to take the sting out of inflation before his 72 re-election campaign. Biden could use an executive order if Congress doesn't give him statutory authority to impose price controls. Without price controls, I expect the Fed to raise the Fed funds rate sometime in 2022 and to continue tightening in 2023. Thus, the next recession could begin in the fall of 2023, but no later than a year later. If the recession does not begin on schedule, it only means it has been postponed, not eliminated. And that's the article's person's opinion on it. What I use for a gauge of the health of the economy is the housing starts. Why do I use housing starts? This is a driver of employment. This is a driver of inflation. And more loans, new loans against new homes is inflationary. It's a credit expansion. I think the auto loans are somewhat tied into this because people do take money out of their homes as they appreciate, and then they go and buy cars and other things with it. I don't do that, but some people do. So here's the new privately owned housing unit starts. We were at 1.77 million housing starts, which is a very strong number. We are getting up to elevated housing unit starts, and we'll get to a spot, I think, a little bit higher with time, and then eventually it will roll over. I don't know when it's going to happen, a recession. I don't know when this stuff's going to weigh down the economy, but I think it's a ways out. That's my guess, and this is my leading indicator. If these housing starts drop below a 1.5 million or so number, 1.6, 1.5, then we're going to get into trouble. 1.6 is this guy here. You get below that, we get these recessions. That's what the gray lines are. Almost all of these recessions, prior to that recession, we've had a decline in housing starts. It's a less leveraging up in the system. It's a slowdown. And we've seen that in the housing starts almost every single time outside of maybe this dot-com bubble. Even though it did go down some, we still had that little recession. We came back up. This was the big boom of the commodities and precious metals. Then we're going to get a big boom, I think, coming up for us ahead. Now, notice that these things, I mean, we had a kind of a double recession here. We'll see what happens here, guys, coming up. We'll watch the housing starts. Join the channel. We're going to talk about this all the time because this is what I think is a leading indicator. We can use the yield curve to determine things. We can use unemployment. We can use all this data. But I like the housing starts the best because that's what's driving that inflation. It's the driver. It's the leading indicator. And this is the new privately owned housing unit authorized in permit issuing places. So this is the permits being issued. And we're up. 1.859 million permits were issued in February of 2022. That's also up. Not all of these will be converted to housing starts, but a lot will. It's a positive sign that we've got increasing housing starts and increasing permits at the same time, meaning that the economy is strong and that inflation will remain strong as well with these numbers, I think. So that's what I've got for today, guys. I wanted to talk about a recession. Not only are people searching it and I get more views, I mean, that's just self-fulfilling there, but it's something that people are worrying about. So it was something I wanted to talk about. I don't think that we're going to have a recession very close. I mean, obviously no one knows for sure, but my leading indicator is the housing starts. And the housing starts, and if you see the 10-year yield start to really drop, and you see copper drop, like a copper to gold ratio, gold starts going higher, copper starts dropping out, and then your housing starts drop. That's the leading indicators. They're not dropping though. Housing starts are going up. Copper price is going up at a faster rate than gold. And we can see that in the ratios when I go over the ratios. And interest rates are going up, the 10-year yield. So I don't think that a recession is really close. I don't think it's coming at this time. Doesn't mean that these indicators can't change. But at this time, I remain a bull in commodities and inflation. And I think the economy will strengthen until it doesn't, and we'll see it in the data. And that's how I do it. I don't make predictions, guys. I just look at the data, and then I go in from that. And that's what everyone else does. So if everyone else is looking at the same data that we are, they're going to make decisions based off that. They don't try to predict, like, I'm going to predict that a recession's coming in approximately 4.3 months. It's like, no, that's not what I do. We'll see it in the data, and then we can adjust accordingly. Give me a thumbs up for the content. Subscribe to the channel if you haven't already. Sign up to the website if you want to. If you guys like this type of information, I don't really go over news articles. I go more over financial education and then stocks and ratios and stuff, so you guys can be better prepared for what's coming. Thank you, guys. This is Finding Value.